All right. Good morning, everybody. So today we have the JOLTS number and we get the FOMC meeting minutes. These minutes, for the most part, contain information the market already had heard. They're just going to get it in a more detailed format. Some of the key things that the market is looking for is any inflection or discussion or hint about what the target rate is going to be. So that's going to be something that the market's going to be looking for. When these minutes are released, the algos are going to scan the report. You know, it's a computer, it takes moments. And then there'll be this immediate reaction to the report, followed a little bit later by, you know, the human reaction to the report. It very well may be the deciding characteristic to get us out of this range that we've been in. One can only hope, right? So right now, bad news is still good news, as bad news will imply that all of the damage and the work that the Fed has been doing is actually accomplishing their goals. So on the docket today, 9 a.m. and then, well, 10 a.m., depending on your time zone, and then 2 o'clock for the FOMC minutes. And, you know, not to be outdone, we also have the ISM manufacturing PMI as well. So it should be an eventful morning. As you can see, ISM manufacturing is highlighted as a potential impact event. It's not a surprise. And then the FOMC minutes are also highlighted as potentially impactful. The JOLTS number is a number that is gauging how many people see that the grass on the other side is greener, right? I always refer to this as the take this job and shove it number. In tight labor conditions, you keep the job you have because you know, are concerned or worried that if you lose the one you got, you may not find another one. And in a competitive labor market where everybody's competing to get employees, say like last year, they were paying up, they were, you know, adding bonuses and sign-on bonuses and other incentives to get people to come in and work for a company. That's two different sides of the coin, right? And so last year, I read an article that said people who traded in their job and went to another job got more of a raise than people that stayed at their job without moving to a different job. Because even though most companies provided a raise to people last year, those who were hired into a new company not only got the raise, but also got, the competitive wage increase. So it's odd, that commitment to a company is actually costing people money. All right, volume's light compared to yesterday, but still within our standards. It makes sense that it's light this morning, considering all of the economic data on deck today. I mentioned yesterday afternoon that we were likely done and we were going to range for the rest of the day because we had this big event on the horizon, and just hard to imagine that they were going to run it all the way back up or continue to run it down lower after around noon or 1 o'clock. It makes perfect sense that everybody started to back up and back away and prepare for today's economic schedule. And the volume here reflects that. So not a surprise. We started to leave the range of yesterday, so we had an inside week breakout. It didn't last, came right back in, didn't stick. Right now we're sitting inside day with a very narrow IB. So the IB is the first hour of trading from 6 to 7. That was our IB last night, that very narrow box. I mentioned yesterday, once we had set this high in the pre-market, that we wanted to watch at the open for the market to run up and test that high and then dump. I didn't know it was going to do that. We had that potential or that possibility because the setup was there. And it's what we ended up getting. Fake breakout, fast failure, right? This, you never know if it's going to do that, right? If we had known, then could have made even more money on it. But it was just the idea that once it had set that peak, the setup was there, right? So this morning, we don't have that peak. We've just got this tight cluster, this consolidation around the daily pivot point and the weekly pivot point. And we're very close to being in the 50%. You see, that's where the market is tangled up right now. So 100% indecision, right? There's absolutely nothing here to give an edge or guidance in one direction or another. It's all going to be dependent on the data that comes out today. The China ADRs are getting some fuel this morning. We'll circle around to those, but Alibaba, which is often considered the benchmark for the China ADRs, like the golden boy, is doing really good this morning. We're still messing with this range here. Which is why I keep talking about we need to get out of this for anything else to happen. And the longer we stay in this, the bigger the move is going to be when we finally come out of it. 10-day, 30-minute volume profile with the point of control very nearly in the middle. It's a relatively tight range compared to what we've seen over the last 2 months. From 3,800 to 3,918, give or take, it's, about 100 120, maybe 130 if we go outside the box a little bit. So pretty narrow. And we're right at the point of control. So this is like a fulcrum point and gravity. So we're looking for the market to significantly break away from this spot. And there's some mild price shelves around 39.11, the cog line, and 38.11, the cog line on each side, but not enough there to actually have any significance to it. So other than the fact that they are a cog line and they're very close to a roundy, like the 3,900 and the 3,800, there's really nothing. Below 3,800 should put us into an air pocket of risk. We're still seeing about a 25-point spread between the SPX and the ES. So yesterday in the SPX, we got below 3,800. That's where the defense stepped in. We don't really have any VPOCs to deal with unless we happen to expand below 3,790 or 3,800 and get down to 3,790. So let's talk about this expansion for a minute, because today we have the potential to really expand considerably. Let's kind of just knock some of this stuff off. We don't have a market maker move, which I think is maybe missing the point a little bit. But these front contracts are still lower than the back contracts, and so there's no market maker move yet. But the range right now is 39.20 to 37.64. So let's just draw that for a moment. This is the average daily range, the ADR. Kind of put that in context of where we've been over the last week. And you can see that it does a reasonably decent job of showing the range that we've been dealing with. But today we have the opportunity or the capacity to make an even bigger move than this. The ADR right now is 78 points. It's 2%. I say a 3% move is entirely possible today. So from the close of yesterday, it's marked 3%. And that gets us up to 39.62. Now we want to do the same thing going in the other direction. $37.28. That's the capacity of the move that we have. And even a 3% move wouldn't be an outlier, right? We've seen plenty of 3% moves in 2022. It wouldn't surprise me at all that we're going to continue to see that level of volatility, at least through the first quarter of 2023. So now we're looking at a move from 37.27 up to 39.62. Very likely that we overshoot that a little bit, maybe pull back in afterwards. It doesn't have to move this big. Keep that in mind, right? The discussion at this point is that we have the capacity to make a big move, but we've seen where the market anticipates a big move and gets no move at all, right? So I'm not saying it has to make this big of a move today, because it doesn't. Yesterday's numbers that came out were spot on in the consensus estimate. It wasn't a miss. They had it all under control. And we saw basically nothing really shock and awe come out of that. I was impressed that they actually got one right, because, you know, their track record recently hasn't really been all that impressive. When we carry those lines out to the daily and the weekly chart, you can see it really doesn't offer much. On the move to the downside, it would just be a continuation of this sell-off that we've already been dealing with. And a move to the upside wouldn't even be close to giving us a new high, on any kind of consideration that this may just be a pullback before continuing higher, right? Because we had that higher high, and so far we've got that higher low. So there is an argument that we're still in an uptrend. 2 higher highs, 2 higher lows, that is a full set, and that is the very definition of an uptrend. The argument could be made that these aren't much of a swing, though, right? That these pullbacks don't really set much for, you know, the higher high status. We would want something that has more follow through to it, right? Multiple candles in a clear, convincing move. And this seems a lot of chop. So the 3% move today, up or down, if we were to even get it, still wouldn't give us anything if it was an upside move for a rally potential. Until we get above at least 4,100. And the argument could be made, you know, until we get above that highest wick, which would be somewhere around 4,200. And we actually get a higher high, then any move to the upside is suspect and has to be taken, you know, with a reduced position till we at least get above that. And in the bigger context of everything, we're still in the middle of the range. Now, granted, this range is huge. It's 800 points. The whole idea of don't diddle in the middle. If you didn't trade inside of this, you could be sitting out on the sidelines for months, right? So, you know, we got to get in there somewhere. I think the argument could still be made if we break below this triple week range that we've been in, that should trigger the continuation of the move to the downside, and we can complete this rollover at least back down to those 3,600 lows. But any break to the upside, at least today, just even getting to that 3% move won't be enough to put us back in a bullish trend yet. We've still got the dollar Japan and dollar China not quite moving the way we would expect. US dollar Japan still has that 131 to get through, which it worked on it yesterday, but couldn't complete it. That is now 2 different attempts. Persistence beats resistance is a phrase worth learning. More times it kicks on that 132 door, the more likely it is it's going to make it through. It's not always true though, right? At some point, traders can give up and just flip it and run it the other direction, but 131 is still the level to keep your eye on. 131 and a half, perhaps see it for that next higher break level. There was even news on Finance Juice this morning about US dollar Japan. And I heard the year 2023 is going to be the year of intervention. We've seen, an intervention in US dollar Japan last year, and everybody's asking who's next, right? Like it's not even close to being done. And while it was Japan, and Japan could perhaps do it again, it's likely that it's going to be another currency. So it's still going to be the thing to watch. Keep your eye on US dollar Japan, but it's not the only one, right? I don't sit and stare at them all day, but I do watch the other pairs as well. Thinkorswim has a little bit of it's kind of a goofy little tool, but it does work. There's a widget for the currencies. FX currency map. Kind of give you the popular pairs. KWEB is up 4.5% this morning. $33.23 puts it all the way outside of this box and very nearly outside of the top of the range. Alibaba's up to 98 this morning, had a close of 92. Now, there was some discussion that it's likely not going to stick, right? This is a reaction to some of the backing away from the aggressive China policies. China went after Alibaba pretty hard, right? It was a while back. And the moves that we're seeing, or the articles that are coming out, is that China has finally moved on from kind of putting their thumb on this ant dude's head, and they're going to go put their thumb on some other sector, which, on one hand, that sounds pretty good for China tech, but if it's not going to be China tech, what are they going to go to next? And it's been this rotation over a decade where that China regulatory body just swaps from sector to sector and basically beats it down into submission and runs it through, come out again on the other side. So how long is it going to stick? I don't know. Alibaba's the top name in that list, but there's still others like JD, which is up to 61 and some change this morning. JD hasn't made it outside of that pivot point right there, so I'd be a little concerned of a rejection. But if it can get going this morning, then it has the capacity to make it up above that 67.5. Baidu is at 126. It would just use a little rounding error there. So opening up above that line that I've got there will put us right into trash. No clear sailing here on Baidu, but it would be a line in the sand, right? So if we can get a close above that line, that 125, could be looking for, maybe not a momentum play like buying calls, but you could run like a line in the sand play, more of a sell a credit spread type thing. But I would sell it at the money. I wouldn't try to go out of the money in a put credit spread, risking 3 to make 1 or 4 to make 1. That'd be a bad idea on this, because it could very easily just flip back the other direction and crush us. But an at the money play would give you a lower risk to reward ratio and a higher profit factor. So less risk, more profit. And if the trade is wrong, you'll know immediately, because it'll break and close back below that line in the sand there. Billy's not up much. So Alibaba, JD, Baidu, Futu. We've got over a dozen names that are up, more than 4%, and more than 20 names up more than 2%. Li Auto is in that list. And Neo, XPEV. Certainly a lot of, common, well-known names at this point. I don't think you really want to focus on the really low market cap weighted names. I think my cutoff on this list was somewhere around 5, maybe 6. No, I went all the way down to 1. And I think the reason I did that is there were some names below 5 that I wanted on the list, but I'm looking at them and I think I should have just stuck with my 5. Either way, you can see the representation. Where's the money going this morning? China ADR. Now, the thing we want to really focus on is it going to bleed over, right? And someone way smarter than me makes the statement that without capital rotation, we're going to get volatility. I love that sentence, by the way. I mean, it just encapsulates everything that we deal with on a week-to-week basis. If we don't get this capital rotation that we're looking for, we're just going to see a whole lot of volatility in the market until it finally does start to rotate. So we want to see this money flow, not just in the China ADR. That's one small segment of everything that we focus on, but we want to see it kind of bleed out and spread out into everything else. Yesterday, the defense names were getting whacked pretty hard. Is that a part of our capital rotation? And if it is, where's it going? Very likely into the already beaten down bigger market cap names, but that's not the China list. I mean, that doesn't even come close to representing the China ADRs. I like the top 20 names in the NASDAQ 100 by market cap. That's usually a good way to go. They're not, quote, tech necessarily. And I added a few in like Goldman Sachs and Morgan Stanley. They don't fit, right? But they just kind of balance it out, my own little watch list. And Microsoft is not participating with everybody else. Kind of violent this morning, down, more than 2.25. And Morgan Stanley. Now on Morgan Stanley, notice there's nothing really here, right? They're just dashes. So until we actually start getting some flow in that thing this morning, I wouldn't count it down and out like that. Count it more as a zero play until something turns around. But on the positive side, PayPal, NVIDIA, Meta, and NVIDIA, there was chip news this morning, something to also focus on. If you're short the chip sector, might want to cover a little bit. I'm not saying you got to get out of everything completely, but it's going to get some pop today because of that news, and it could carry through for a couple days, really kind of squeeze you if you're short. So something to consider. The move in Facebook yesterday was impressive, and it kept it, right? That was, I don't know what I was more impressed with, the move itself or the fact that it stuck. Either way, we're outside of the range that I've got set at that 124, and I want to see it close above that level on the week. If you're just looking for some, trades, intraday trades, whatever, a fail back below 124 would be a great short down to that 118, 120 area. I don't think it's going to fail though. So on the other side of that, if we don't fail, a Busby would be really good. So a Busby is a phrase that I came up with when a market sets a range and then comes back up and tests against that range and then breaks out of the range. Very often when a market does that, it will then come back and test that old resistance as a new support before continuing on in the move. Well, that's a lot of talk to say all of what I just said, when I could just say, ooh, it did a Busby. Like it did right there. It did a Busby. It broke out, came back and retested the breakout. Simple as that. A lot of trends first start by breaking out of a range. Makes sense. We were range bound. We broke out of that range and we began trending. Now, while a lot of people like to trade the Busby, I like using the Busby as a signal that a potential trend is unfolding. More of a confirmation that the range that we had been in is now over with and we're moving into something else. So at this point, that 124 is my line in the sand. That's the range that we've been in. We've broke out of it. Are we going to get a good Busby or not? A nice bounce off of that range. Maybe overshoot it a little bit, right? We can overshoot first and then punch through and continue the move. Or is it just going to break back down inside the 124 and we start targeting that 118 area? Meta and Netflix are the two contrarian plays on Seeking Alpha for 2024 that really got my attention. I'm sure I've got a little bit of bias in there too. I would really like to run one of these heavily beaten down names back up, right? And Meta and PayPal and Netflix, and there's quite a few of them that are significantly beaten down, right? This thing went from nearly 400 down to 100. If there's a run to the upside on this, even half of that, right? Running it back up to say 200 or 220, 240 by the end of the year. I sure do want some of that. It's very likely not going to be an easy run though. And at some point we need to get an entry. So we first need to validate that this is actually going to turn around and not just continue to base down here and or continue to go lower. We don't have that yet. And it does have a market maker move of 1.5 this morning. It's up, closed at 124.7, and it's up over 126.5. So it's not up by much yet. $129 would be the gap close, 129.70. I would say if we get above 128, we're going to pull like gravity all the way to that 130. But we have to get close enough to it first for that to start to happen, right? And for all of that, we need to stick above that 124.74. Tesla's up this morning. Kathy Woods bought the dip, and she kind of brought in a wave of people behind her, little Kathy followers. It's really hard to gauge if something like that is going to stick. But if you look at the flow that's going into Tesla, and there was a tweet from one of the big dogs, not Thinkorswim, but someone like that, IBKR, one of those firms. They can look at the position size of net buying in their entire brokerage platform and see what the symbol is, right? And the number one or the top in the top 10 is Tesla. Tesla is still being bought across the board more than nearly anything else right now. Who's doing the buying? Funds, firms, small investment corps, proprietary firms. There's still a lot of buying. It's in the top 10. It didn't hit the number one spot, but if you think about the entire marketplace and where somebody could put their money, this still hits the top 10. And then she brought in, that whole wave of people that follow her into this. So like I said, is it going to stick? Well, it's been heavily bought through all of this move. And I'll just leave it at that. Everybody that was still heavily buying at 290, I'm sure they're not very happy about it. And everybody that was still buying at 200, and I'm sure they're not very happy with it. So don't look at it now and think, oh, well, yeah, Kathy did it. I don't think it's done yet. And to be fair, it's not just Tesla, right? If you are keeping track of the auto space, I mean, look at Ford, down from $26 to $11. General Motors from 68 to 33. In the short term, however, with Tesla, we are oversold in the most classic of sense. And, at some point, we are very likely going to get a bounce, a dead cat bounce. Now, it could be argued that we already had it with those 3 days. But what comes to mind is something that Peter Resnicek liked to say a lot. That's the guy that runs Shadow Trader, right? The Shadow Trader chat room. And he's been around for a long, long time. This H pattern here is, it stands for hell for shorts. That this is a bullish pattern. Now, that's not my phrase. I'm not the one who said it. It's his. We could get that kind of move. Here's the H pattern. And if eventually it made that move up, but that's one heck of a move to the downside. And while it's possible that we could see that kind of upward move out of this, I wouldn't do it blindly. I'd still be looking for a setup. Google's getting a little bit of shakeup this morning. It still hasn't managed to get outside of the box. We're focused on inside week. So this is an IX10 pattern, and we're looking for a breakout. Notice we've had just a slight expansion on the downside, and now we've had a slight expansion on the upside, and neither one of those followed through anywhere. And it's very likely that the liquidity is a little deeper than that on each side, right? It didn't trigger into a liquidity model yet. Probably needs to go a little bit further. Google's got a market maker move of 1 1/4 and an average daily range of, we'll call it 2.7, just for some easy numbers. So that's 3.7. That's nearly a 4% move that Google could make, and it wouldn't even be an outlier. The shape isn't really there, but this is a TRB setup as well. All right, so you're looking at a trend line breakover with an IX10 breakout if we get that upside move. All right, we're getting a little bit of a Busby here in Apple. But I want to stress caution on this. IBD talks about a double bottom as a trap, right? If this is a classic double bottom, the target's going to be back up into that 131 area. And to make that move, what they want to do is trap a bunch of shorts. So they break the previous low first, suck in all those shorts and then run it against them the other direction. And those shorts have to buy to cover, adds to the buying frenzy, and you get that hard, solid rip to the upside. So if this is a classic double bottom, so far it's taking the shape that it's supposed to take, right? That's exactly what we would want to see. My argument is, though, when you come out to the daily, if it was a classic double, it should be farther apart, right? Like it's too close. Even this over here, I would argue, while it was a double bottom, it didn't go deeper. It wasn't very far apart. And even though we got the follow through, because it only owes you back to the top, we got that. It was also the last hurrah before a significant dump down. So if this is a double bottom, then it really kind of only owes you back to that 130, 131 anyways. And that's like $5 from our current location. And we've got a $7 expected move. So we could easily hit that in a single day and still dump and roll. So I would stress caution on that double bottom. As a day trader, sure, no problem. But for a swing trader, this thing is still looking like it's headed to the downside. Comcast has made 50% of the measured move out of this range. 50% is the first stopping point. So, we could watch this one close. If it stabilizes and we get in through the open, holding above that level, we've got a shot at 36.18, which would be 100% of this measured move. But it's not getting the flow this morning with everything else that's getting money flow. This isn't, right? It really hasn't got much of anything this morning. And we're still seeing energy take it on the chin. See what crude's got going on. A little bit of a reflexive bounce in crude. And it looks like we're starting to get an expansion in futures. All right, so you should be pretty set for the day. keep a focus on the China ADR names. See if it starts to bleed over into the other sectors. We've seen them start to run the banks yesterday. And remember, we're coming into a new earnings season. Banks start the season and usually set the tone for the quarter, right? So they're running it up. It could be, just running them up into earnings and then dump them on their head, gonna buy the pre-market or, pre-earnings. But if today is going to turn bullish, if we're going to flip over and start seeing a run up, then it needs to be that rising tide, right? We want a very high correlation coefficient across the board, not just some China ADR names, but in everything. And if it all begins to unravel, even the goodwill or the good news coming out of China should begin to unravel too, right? I don't think it should be able to stand as an island against the kind of negative flow that econ can bring on a day like this. So if we're going to start heading to the downside, K-Web and all those other China ADRs, JD, Baba, Baidu, they should all start to roll over. And considering they're the ones that are up the most this morning, they would be a good bet to aim for, for something to short. I'd rather short something from the highs than short it from the lows. Microsoft continues to be one of the last holdouts out of all of the big mega cap names that really just hasn't suffered as much as the rest. From a perspective of shorting, this has a long ways to go compared to, say, Meta, Netflix, PayPal, right? A lot of those others in its peer group, in the monsters of tech, that have taken that significant beat down. I still see a lot of talk about being short Microsoft. I'm short Microsoft, but I can tell you my puts are down over 50%. And the only reason that I'm still in the trade is because I've sold puts against my long puts to cover that difference, right? If I was just buying puts and holding them, I'd be down a lot, because these options in Microsoft are expensive, and this thing is just continuing to hold on and not fall out. So if you're thinking about shorting Microsoft just because it's one of the last names to still be standing and hasn't broken down yet, it's not going to be an easy hold. But you have to be short before the short, because when this does start to go, it's going to be just like Apple and Tesla and the rest. It's going to happen real fast. And, it can happen fast enough that you miss the darn thing. Yeah, I've got March right now, but it's getting close enough to March that I'm ready to start looking out a little farther. So I haven't done it yet, but through the afternoon today, I wanted to check liquidity in the April and June series, see which one of those is looking better. I was in March when we were still in October. So, kind of looking farther down the road. And a lot of that has to do with how much money I can get on the short puts, knowing that my long puts they're just not making money. But I'm not in a huge rush. Still got 72 days. It's not like I got to get out of what I've got, immediately. It's just we're getting a little close, and I run out of room for calendars and diagonals. I like more choices. Now, if you look at Apple, the argument can be made that we're just getting started. Apple, Microsoft, they really haven't given back much yet, as opposed to something like Facebook, even Nvidia or Google. Netflix, PayPal, these demonstrate what we're looking for in Apple and in Microsoft, a significant move to the downside, a real repricing of company structure. And at this point, that's not even close to what we've got. All right, everybody, be careful, be safe, keep your eye on the clock today. It's absolutely entirely possible that the morning econ gets undercut or overwrote by the afternoon econ today. Both of these events are very big. So we could turn really bullish this morning and then get bearish this afternoon, or vice versa. So it doesn't have to stick. And I wanted to add that caution to everything. If we get morning and afternoon that are both bearish or both bullish, hey, that'd be great. But it doesn't owe us that. So could be a pretty wild day. Just keep track of those 3% ranges that we marked out in the S&P. And you should be all right. Have a good one, everybody. I'll see y'all tomorrow.